Every choice made in an environment of limited resources requires the abandonment of a specific alternative. In microeconomic theory, the true cost of a decision is defined by the value of that best alternative foregone. Because time, capital, and materials are finite, this calculation acts as a primary mechanism to ensure those scarce resources are being used as efficiently as possible. From corporate balance sheets to global trade and healthcare infrastructure, every trade-off follows a single mathematical relationship. Value equals the chosen option minus the foregone alternative. Understanding this metric allows us to look past accounting illusions, identify the optimal geometry of international trade, and map the zero-sum rationing forced by systemic crises. Opportunity cost serves as the universal metric for evaluating whether a decision actually creates or destroys value. To see how this scales, consider a firm-level scenario where a sudden equipment failure disrupts normal operations. The most visible expenses are explicit costs, the out-of-pocket cash transactions for things like raw materials, utility bills, or employee wages. If an office printer malfunctions, the cash paid directly to the repair technician constitutes the explicit cost. These figures are easily identified and recorded as expenses on an income statement. Implicit costs, however, represent the intangible value of resources the firm already owns, which could have been used for other purposes. These are the hidden trade-offs of human labor, time, and infrastructure. In our printer example, the implicit cost is the quantifiable value of the production time lost while the machine was down. No cash is exchanged, but the foregone output represents a real loss in utility.
This calculation must strictly exclude sunk costs, historical expenses that have already been incurred and cannot be recovered. Since these costs remain unchanged regardless of the current choice, they must never influence present opportunity cost calculations. We only evaluate future trade-offs. This distinction reveals why standard accounting profits often fail to provide a complete picture of fiscal performance. Accounting focuses on measurable factors like rent and wages, but ignores the relative profitability of alternatives. Consider a startup generating $10,000 in accounting profit its first year. By traditional measures, it appears successful. However, if the founder sacrificed a $40,000 salary to run this business, the economic reality changes. Factoring in that implicit cost reveals an economic profit of negative $30,000. Despite the positive accounting ledger, the decision to start the business represents a suboptimal allocation of resources. In contrast, normal profit describes the condition where economic profit equals exactly zero. At this point, every explicit and implicit cost is covered by revenue. Total income matches the value of the next best alternative, meaning there is no longer an incentive to reallocate resources. These hidden figures provide primary inputs for institutional finance models like discounted cash flow analysis, where the discount rate itself is influenced by opportunity cost. A business can remain profitable on paper while actively destroying economic value if its capital and time could yield higher returns elsewhere. This logic scales from individual firms to the trade policies governing entire nations. We can model this using a trade matrix for two nations, country A and country B, producing tea and wool. For country A, producing 1 ton of tea requires diverting resources and sacrificing 0.2 tons of wool. Country B faces a higher trade-off, as it must forego 3.3 tons of wool to produce that same ton of tea. One nation might possess an absolute advantage, the distinct ability to produce goods more efficiently or with less manpower. But raw efficiency is mathematically secondary to the trade-off calculation. Country A holds a comparative advantage in tea because its opportunity cost, the wool it must give up, is lower. Therefore, total system output is maximized if country A specializes in tea. By specializing based on the minimum sacrifice of alternatives, global systems mathematically maximize their total production and consumption. The most severe applications of this model occur when scarcity forces governments to ration public goods during a crisis. The COVID-19 pandemic provided a look at the consequences of a systemic shock, leading to a sudden halt in economic activity and widespread social costs. This standard market graph shows demand and supply for hospital bed days initially sitting at equilibrium. The pandemic forces a shock to this system. Because severe cases require prolonged monitoring and ventilator support, the need for intensive care rises, violently shifting the demand curve to the right. At the same time, staffing shortages and equipment limitations can reduce capacity, shifting the supply curve to the left and creating a massive gap of unmanageable demand. In this environment, bed days and ventilation time become scarce resources. The health system must evaluate every allocation, aiming to improve the population's overall health. With demand exceeding supply, the marginal opportunity cost of an ICU bed skyrockets. Admitting one patient often means another cannot be admitted. This reaches a Pareto optimal state, the point where no one can be made better off without making someone else worse off. In this scenario, every medical choice becomes a zero-sum rationing decision, where the benefit to one patient is mathematically tied to the denial of care to another. These trade-offs represent the fundamental physics of economics, governing both micro-decisions and macro-systems. We see this in adjustment costs, where a firm sacrifices current output levels to reassign labor and capital towards new product goals. We see it in government spending, where billions allocated to war or stimulus are billions prevented from funding healthcare, education, or tax cuts. The explicit costs of soldiers and the implicit costs of lost civilian output both resolve into this single relationship, the marginal cost of a choice. The physical emptiness of a city under lockdown is a visualization of a monumental public policy trade-off, a choice where lost economic activity was the price of public health. Analytical rigor requires us to look past simple cash transactions to see the full scope of a decision. Every choice we make carries the weight of the alternatives we leave behind. To measure the value of what we have, we must first calculate the value of what we sacrificed to get it.